This 5-mark question on capital and revenue expenditure has featured in AS level business exams many times, and it's one of the easiest places to pick up full marks if you know the structure. Today, I'm breaking down exactly how to answer it. Let's get started. Explain the importance to a business of distinguishing between revenue expenditure and capital expenditure. This question is for 5 marks. To start off this question, we need to define what capital expenditure is. The purchase of non-current assets that are expected to last for more than 1 year, such as buildings and machinery. Capital expenditure will be recorded in the balance sheet, or also known as the statement of financial position. So here where my purple arrow is, this is where my fixed assets or my non-current assets will be featuring, such as vehicles, machinery, buildings, equipment. Capital expenditure will also affect the value of the business. The formula for owner's equity is assets minus liabilities. Let's have a look at the balance sheet again. Capital expenditure is affecting my fixed assets. The depreciation on fixed assets is recorded in the income statement or the profit and loss account. Depreciation can lower the profit for the year and therefore the taxable amount. A basic income statement. Now for the next part of the answer, I need to define what revenue expenditure is. That is spending on all costs and assets other than non-current assets, which includes wages, salaries, and inventory of materials. Now, an easy way to distinguish between capital and revenue expenditure is your capital expenditure is the spending on all fixed assets, and revenue expenditure is basically the spending on everything else. Now, my revenue expenditure is recorded in the income statement, or also known as the profit or loss account. In my basic income statement, where this purple arrow is, this is my overheads or my other expenses in the business, such as wages, salaries, electricity, and telephone, as well as purchases of materials that forms part of the calculation of cost of sales. I'm not delving into how we calculate cost of sales today. Now, revenue expenditure affects the profit of the business. This profit is recorded in the balance sheet and affects the owner's equity value. If you watch shows like Shark Tank or Dragon's Den, those sharks or those dragons are very much interested in your operating profit margin, because if you have a higher operating profit margin, a higher percentage, it normally is a good sign.